Hello, everybody. Welcome to the third episode of Ballantyne's Road to Recovery series. Today, we are going to discuss what the economic landscape looks like in 2021 and beyond. As a reminder, this series is less about the immediate tactical here and now and more about the long-run view that people should be thinking about to position their businesses for success. The COVID-19 pandemic has obviously significantly disrupted the world in many ways. It has forced changes in personal behavior, business operations, and had a drastic impact to the economy at large. Today, we are going to focus about what the economic trends this public health emergency has accelerated and what the strategic implications are for businesses. At Ballantyne, we are committed to not only helping our clients navigate these challenging times from a wealth management perspective, but we have found during the last few months that many are looking to our firm to facilitate discussions around key topics about what the future may look like in a post-pandemic world, bringing in subject matter experts and their opinions. We have already discussed trends in private capital and innovations in the global supply chain during our first two webinars. So it's exciting that we've been able to bring together this all-star panel to share their different perspectives on the economic road ahead. We selected this group because of their complementary vantage points. Our panelists have a unique view into the inner workings of the economy and how it's likely to impact businesses in the years to come. Firstly, let me introduce Don Rissmiller. Don is an entrepreneur and business owner. He started Strategas to bring objective and independent macroeconomic research to institutions and executives. He is a highly respected economist and brings a perspective from the research department of the Federal Reserve. Secondly, as former CEO of Home Depot and chairman of the board of Delta Airlines and Grady Hospital here in Atlanta, and as a director of Macy's, Frank Blake brings valuable perspective on what is on the minds of CEOs and CFOs of corporate America. What is unique about his experience is that he served in both government and corporate America. Frank served as general counsel for the United States Environmental Protection Agency and as deputy counsel to George H.W. Bush during his vice presidency. After that, he turned to corporate America and climbed the ranks at General Electric as Jack Welch's protege. So we could not think of anybody better who knows the ins and outs of institutions, government, and big businesses than Frank, and we are very appreciative of his time today. Finally, Joe Galvin. Joe has done great work at Vistage International, giving a voice and identity to the small and medium businesses that create so many jobs for our economy. Ballantyne has been a Vistage company for decades, and Vistage has its fingerprints all over our company. I always enjoy collaborating with Joe and talking to the Vistage network on a range of topics. What you won't be able to see from the screen today is that Joe is nearly 7 foot tall and nearly played in the NBA, so he is a man of many talents. But for today, I'm looking forward to Joe's insight on what's on the minds of small and medium-sized businesses. So with that said, I welcome each of the panelists and thank you to Don, to Frank, and to Joe for investing time with us today. I'd like for you all to zoom out from the here and now, and I'd like for you to put us into 2021 and beyond. We'd like to focus our discussion today on the longer run trends and the strategic impact of the coronavirus pandemic. So much attention has already been drawn to how this crisis has accelerated really important secular trends for businesses that were already in place, such as the digitization of payments, e-commerce, supply chains migrating from a just-in-time to a just-in-case model, and to companies considering permanent flex time and remote communication for their employees. Don, I would love for you to set the table for us. What do you all at Strategas Research Partners think will be a future of the future economic landscape that we are not yet thinking about?
Yeah, well, it's great to be here and share some thoughts. So there are a couple things that have already come into place. If we look at things like telehealth that weren't all that popular before the pandemic, you've already made significant progress in that direction. Online education, especially for higher education, is something that looks like it's going to stick around. But more fundamentally, we're probably going to see a push for things like onshoring. This could get into the manufacturing sector. If we really want to make a dent in the onshoring story, we have to get into some of the fundamental industries. So we'll see. This is going to be a political choice, but I would guess this is going to keep coming up for probably many years here. What does the supply chain look like? Do we have enough onshore? Do we have strategic industries onshore as well? One other item we focused on is what's going on with some of the precious metals, especially something like gold. So this has not always been an obvious investment choice. It really works in periods of deflation or inflation. So you could say it worked in the 1930s and worked in the 1970s, but you didn't have a need for it so much in the intermediate periods. Now we have an aggressive response from many policymakers in many countries. And I would expect that we're going to see alternative stores of value and things like gold continue to attract attention as we go forward from here.
Yeah, with the gold price hitting 2,000, who would have thought that this week? That's something that's front and center on our minds as well. We've been allocating to that as a store of value in our portfolios for several months, somewhat successfully. Let's turn our attention to the comments you made about policymakers. And it seems to me that the Federal Reserve, an institution that you obviously know very, very well, has clearly learned from the last crisis we experienced in 2008, 2009, and has been incredibly proactive and bold in attempting to bring relief to the economy this year. You know, prior to 2019, consensus was worrying that the Fed was out of bullets in dealing with the next downturn, and yet the capacity of the developed world to stimulate the economy this year has been nothing short of spectacular. There is talk of doing more fiscal stimulus and an extended period of low interest rates, as policymakers are embracing a form of modern monetary theory and perhaps even universal basic income in their response. And those were both deemed pretty radical and unorthodox concepts until now. And this is from a Republican administration, no less. I recall Dr. Ben Bernanke telling me that the thing he regretted most about 08-09 was how the Fed lost the communication battle with the average citizen, and how that set the stage for the populist backlash we have been living through over the last few years. What do you think is going to happen to this national treasure of ours now? Will the Fed continue to be this nonpartisan institution that people respect, an anchor of stability in an unstable world, or will it continue to fall victim to politics? And what do you think are the implications of that for business owners through the theme of deflation and inflation?
Yeah, I think it's a very important question, a developing question. And so I never thought I'd say that 2008 was a good experience. But if you think about what happened in 2008 and 2009, we put together a number of policy tools that at the time were considered very radical. We had to think about how to make up the primary dealer credit facility, the money market facility, the commercial paper facility. These were not things that were readily available. But having gone through 2008 and 2009, when we got to this crisis, we had some things that were on the shelf that we pulled off very fast. And then we expanded the model very quickly too. So we used that same model to help the corporate market, to help parts of the muni market. And so having gone through 2008 and 2009 and done the legal work and the monetary policy thinking around how some of these credit facilities could work, probably helped avoid a worse downturn this time, because we were able to act so quickly on the monetary policy front. And so we didn't really have a credit issue on top of the lockdown. The lockdown itself hurt business, but that could have easily caused additional credit ripples. And I think the Fed did a good job preventing some of those ripples from spreading. And I think they've committed themselves to continuing to do that. The Fed really doesn't have the authority to fix a solvency problem, though. So if your business doesn't continue to make sense, if you were running a restaurant that doesn't work, if you can only offer table service to every other table, if you were running a retail establishment that doesn't work, if you only get half as much foot traffic, or if you're in a travel business and that has been impaired because business travel is simply non-existent here for a while, then you're going to have to make different decisions. And the Fed really can't and probably shouldn't address that problem. That's where fiscal policy would come into play. There may be industries that need grants. Look at the airlines as an example. Look at some of the trucking companies. So this has happened, but it really should happen through the fiscal policy channel rather than the monetary policy channel. I think the concern going forward is these two types of policies start to merge, that we've had an independent central bank for quite some time. We like that because it's helped anchor inflation expectations. But with deflation such a concern, it would not be surprising to see the two types of policies start to merge more into one. And so does that jeopardize the dollar as the reserve currency? Does that start to change global dynamics? And I think the answer could be yes. I don't think we've made the decisions along that line yet. I think that's going to be really about how after the pandemic, after the economy starts to recover, we start to act. So if we're doing something that looks like MMT right now, do we continue to do it when the unemployment rate is 5%? Do we continue to print money to try to get to full employment when the economy is in a different position? And so answering that question really gets to the symmetry of monetary policy. Monetary policy is supposed to be symmetric. You don't change your trend growth rate with monetary policy, you move growth around in time. So your trend growth rate is determined by your technology set, your inputs of those kinds. What monetary policy does is it says, I'm growing too slowly today, let me ease and pull some activity forward, or I'm growing too quickly, let me tighten and push some activity off to try to stay around that trend as much as possible. And so if we morph that into a fiscal policy role, we open the door to a variety of things we haven't had to talk about in quite some time, whether that's inflation or currency issues. So we haven't done that yet, but that could be ahead of us.
So the bottom line is short-term continued deflationary pressure, long-term inflation and potential currency debasement. It feels like, the world of macroeconomics and policy response have gone full circle. I think it was President Nixon that said, we're all Keynesians now after we left the gold standard in the early 70s. And I like your quote of, we're all modern monetary theorists now. It's be interesting to see how that plays out. Thank you for your introductory comments. Frank, you served in George H.W. Bush's administration and talked about your favorite memory of working with Supreme Court Justice John Paul Stevens in your podcast series, Crazy Good Turns, which I highly recommend to everyone listening today. So you also have a unique vantage point into how our national institutions work. But I'd like for you to share your perspective from management and the boardroom. As the former CEO of Home Depot and the current chairman of the board of Delta Airlines and Grady Memorial Hospital here in Atlanta, and a board member of Macy's, you've had a front row seat for watching how organizations have had to pivot during this year's health pandemic and ensuing economic crisis. To the extent that you can share with us today, what is on the minds of CEOs, CFOs, and boards about the challenges and opportunities big business face in 2021 and 22 and beyond?
Well, first off, thank you, Adrian. It's a pleasure to be here, and great to be here with Joe and Don as well. And thank you for the reference to Crazy Good Turns, the podcast. I'll start by saying that it's hard to generalize on CEO and CFO focus because the experience across industries is so very different. So in addition to the boards you mentioned, I'm also on the Procter & Gamble board. This is a good time to be selling toilet paper and cleaning products. It is not a good time to be in the travel industry. It is not a good time to be a department store. So very, very different experiences as those businesses grapple with the problems that the pandemic has caused. I'd say that there are a few things that are common across all industries that CEOs and CFOs should be thinking about. And the first is every crisis changes habits. I mean, that's one of the nature, it's the nature of a crisis that it snaps habits that we didn't maybe even know we had the habit. But then it changes and you get to observe, do I like that habit? Is there a better habit? Or do I really want to retain that habit? A very obvious one, and you said it at the start, Adrian, is consumers. If you look at the latest data I saw on consumers doing buy online, pick up in store, there's 40% of consumers had never done that before, brand new to that vehicle for shopping. You got to believe that a new habit has been created, and it may not sustain at quite this level when the pandemic is a distant memory, but it's going to develop a new habit. And you see that in companies. Similarly, companies have internal habits in terms of how they meet, how they plan, all of the mechanics of moving a company forward have been dramatically changed by the pandemic. Some of it to the good, some of it to the bad. So take a good one example many businesses have faced into is if you had asked in February of this year, if you had asked any CEO, how long would it take you to plan to have your entire organization online and out of the office, you would have had an enormous planning effort. And probably the answer would have come back, it's not feasible. And yet it was accomplished in a matter of days or weeks. There is a good muscle that businesses have learned in terms of speeding up decision making that's come from the pandemic. And then there are some bad muscles in terms of what's been lost in that process. And CEOs have to think through, how do we keep the good muscles? How do we sustain those good muscles, faster decision makings, and and cutting through some of the clutter within organizations, and how do we build back some of what we lost? The same with consumer behavior. What are the new behaviors? How long will it take us to embed in them? What do we do to invest into that? And then what do we think is going to be 2021, as you say? And I think most CEOs, I think this is the ones that have been severely impacted on the negative are making prudent assumptions that the recovery will be a slow recovery. I know, Ed Bastian, the CEO of Delta, has been very straightforward in saying, don't expect business travel to rebound in 2021 to what it was in 2019. It's going to take several years. And I think that that's the prudent, the right way to plan, and the way most businesses that have been negatively impacted are planning for this.
Thank you for those comments. I think those points you made about habits are important, and resiliency of business models that people didn't really anticipate prior to the pandemic are also important. We've seen that in our business of advising clients on their investment portfolios. The long 10-year bull market prior to this year was extraordinarily smooth and plain sailing, and the need for basic good habits when investing, like having cash on hand and so forth, were really exposed during this crisis. So if you were president for a day or even 4 years, what would you be urging your Treasury Secretary to be focusing on to give CEOs like Mr. Bastian and their management teams the confidence they need to take the risk to commit to long-term capital expenditures and investments that will translate to job creation and productivity growth that Don reminded us was so important to the long run, and sustainable economic growth in a post-pandemic world?
So the advice I'd give is, I'm sure, the advice I wouldn't follow, because it's not the first instinct of those in power. But I would say, you've gone through some of the changes that the pandemic has created, like the digitization. Another one, my observation would be government involvement in basic winners and losers on the business side. And it is always a temptation when you're in power, and this is interestingly now true in the Republican Party with the Trump administration, and true on the Democratic Party, to put your thumb on the scale. And I think if you think about the massive amount of worrying that went into the stimulus package at the start of the Obama administration, and the speed and lack of worrying that we've had doing many, many multiples of that with this pandemic, and the itch in the government to start interfering in the economy. And making it go one direction because for one set of reasons or another direction for another set of reasons. I think that's going to be a lasting impact of this pandemic and not a good one. So if the short answer is I'd be telling my Treasury Secretary, liquidity in the market is hugely important. Work with the Fed on that, and otherwise stay out of calling who wins and who loses.
Yeah, it quickly becomes a very dangerous game.
Yeah.
Joe, let's pick up on Frank's theme there of letting the economy do what it's intended to do, and for politicians to get out of the way. So much of the media's focus and attention is obviously geared towards big business, as Frank has just described. Meanwhile, most of the jobs created in our great country come from small to medium-sized businesses, a product of their entrepreneurial, risk-taking founders. Tell us about Vistage International, the Vistage CEO Confidence Index, and the collaboration you have struck with the Wall Street Journal on bringing a voice and identity to the silent but powerful majority. And tell us a little bit more about some of the important themes and conversations that Vistage companies are having around the country about the future economic environment in 2021 and 22 and beyond.
Thank you, Adrian. It's a pleasure to be here today, and it's a real pleasure to be with Don and Frank. Vistage provides executive coaching and peer advisory boards for CEOs of small and mid-sized businesses. We have close to 15,000 members here in the United States, 24,000 around the world, and we help CEOs make better decisions, become better leaders, and get better results. It's a very dynamic and powerful organization, and I thought it would make sense to start the discussion with some data. Vistage Research provides research and advisory capabilities to our members, and we survey our members traditionally 4 times a year. We work with the Wall Street Journal closely on our Small Business Confidence Index. But today, I want to share with you some of the data we've been collecting through the coronavirus crisis, because the data really sets up an interesting dialogue about where small and mid-sized business CEOs are today and what their thoughts are about the future. As I mentioned, we survey our members 4 times a year for our confidence index, and you can see here how leading into this year, Q4 2019, we saw our confidence index increase for the first time in 8 quarters. And we were really optimistic coming into the year that we were going to see the slowdown slowing and a chance to really prepare for prosperity. And then as we all know, coronavirus hit starting in March, and you can see our March survey data taken in early March. Our survey dropped to 84.7, and our June data even lower to 65.5. If we had calculated data in April, it was down in the low 40s, which was well below even during the recession of 08 and 09. So it clearly shows that our confidence index, which is comprised of revenue and profit projections, investment and employee projections, and beliefs about the state of the business and state of the economy, obviously confidence has fallen, but beginning to recover. You'll also notice the demographics of our community. We don't have a lot of leisure hospitality. We have some, but we don't have a lot, and we don't have the big hotels. Obviously, we don't have big airlines. That's not our niche. But you can see manufacturing, construction, finance, insurance, consulting. These are our core industries. Our sweet spot is really, the million to 500 million in size, and the number of employees between 10 to 500 or so. That's really our sweet spot. But let's take a look at what the data tells us, because it's really enlightening. We asked this question: to what degree have your revenues been impacted by the coronavirus pandemic? And you can see here, as we've checked each month, the no change increase bottomed out. May is gold, bottomed out in early May and began to recover. Kind of flat around decrease 0 to 25, a little bit better 25 to 75, and a little bit better on the decrease 75 or more. Our most recent data, and this poll is currently open, shows those numbers haven't really moved. Picked up a couple points on no change, didn't move on decrease to 25%, didn't really move, actually went down a little bit on decreased 25 to 75 and 75 or less. So we reached the first plateau, but it appears that we've stalled there. And a lot of that's being driven by the uneven openness that we've seen, the resurgence or actually the first wave coming through many of our states in the South and now emerging in the Midwest. And as it suggests from a revenue standpoint, we've bounced off the bottom. We've reached the first plateau, but we're now at the next pause. At least that's what the data tells us today. The next question, this is a really important one, is How long will your cash reserve support your business during the economic conditions? And a way to look at that is April is gray, and you can see that was not a pretty picture in April. But then the Payroll Protection Plan and the CARES Act kicked in. And we see a rapid improvement as you look out now for the July data, you see that more people have more cash over longer periods of time. 34% now have more than a year, and 32% 6 to 12 months. And we've seen those numbers increase a little bit, especially now we're up to 37% that have more than a year of revenue. Again, this is directly related to the impact of the Payroll Protection Program, but we've also seen, and this is a question we asked in our August survey about that, and what we found is that 82% of our members applied for the Payroll Protection Plan, and 98% of those that applied were funded. Now we ask the question, what's the status of your PPP funds? And what's really disconcerting to hear is that 75% have already used up that funding. Another 13% have 3 months left, and 12% will make it to the end of the year. This demonstrates, and again, for those companies in deep distress, this demonstrates there's a real cash flow issue on the horizon if we don't see the next wave of stimulus and we don't see the next package come into play. And that's concerning. The next chart and the last thing we'll look at is expectations looking forward. If we know what our revenue is and we've got our cash flow under control, when are things going to start to get better? And we asked this question again. You can look at the April data. We thought 3 to 5 months, maybe 6 to a year, but no one really thought more than a year. Our May, June data began to push that out. The July data, again, became more and more pessimistic, is now 42%, 6 to 12 months, and 24% more than a year. What's disappointing now is when we look at the expectations, we see those numbers push out even further. Now 46% believe it'll be 6 to 12 months, and almost 30% more than a year. What this suggests is, in our community, the belief that the economic recovery is a long ways off, that the hope for V-shaped, rapid recovery is simply not happening, that we're in a situation here where the expectations for revenue are pushed further and further out. You compound that with the cash flow situation that we see and the revenue growth that people are seeing, it creates a real challenge for the small and mid-sized businesses. And yet we see confidence in our organizations and our CEOs and their belief that they can not just ride out this storm, but potentially do better on the other side.
Joe, thanks for those excellent comments, and I appreciate the real-time data. Perhaps, Don, you can add that to your suite of real-time data like OpenTable and TSA foot traffic to get a sense of what's really happening in the economy. I know the Wall Street Journal is publishing this confidence index, Joe, that you are monitoring, and hopefully that can bring some identity to many of the business owners and entrepreneurs out there that are creating all the jobs that are so necessary to get people back to work. Don, in a moment or two, I'm going to ask you to respond to Joe's comment about the need for further stimulus and what that might look like pre-election. But I want to ask Joe one more question. As the former CEO of the Atlanta Federal Reserve Bank, Dennis Lockhart, has published in his research, it's almost as though American entrepreneurialism has lost its, I want to say, mojo. The rate of new companies forming has been slowing. And the new companies that have been founded are employing fewer people because of technological advancements. And of course, that was a trend in place pre-COVID, which is now accelerated. Joe, be a voice for small to medium-sized businesses. Like I asked Frank, what would you tell policymakers to do other than stop picking and choosing the winners and get out of the way?
Well, there's no question that technology has changed everything about what we do and how we think. Frank had commented on some of the behavior change. We've seen 15 years of behavior change in 30 days from March to April, driving all these behavior changes. As that connects to entrepreneurs, we see a strong entrepreneurial spirit. We see our members, especially those, in the smaller band, the smaller revenue bands, smaller employee bands, aggressively looking at how they can leverage technology to be more efficient, more effective in their business. We've seen rapid technological advances that now allow via the cloud, big company applications and capabilities scaled down to allow small businesses to not have to develop, but just deploy and capitalize on those. And having said that, what we will see, I believe, on the other side of the COVID virus, once we get a vaccine and humans get more comfortable with humans, will be an explosion of entrepreneurialism. And that's because there will be new markets. We will not enter, I don't believe we'll enter a new normal, rather we'll enter a new reality. This new reality will be vastly different than where we were 6 months ago. and that'll create tremendous opportunity. Yeah, a number of businesses, unfortunately, are not going to make it. A number of businesses are going to be severely damaged and a long time to recover. But in that gap, we'll create opportunity. And that opportunity will be stepped in and filled in by people who aggressively and intellectually will pursue these markets, capitalizing on technology and capitalizing on what will become a reemergence of the consumer need. Our economy is driven by consumers. And when you provide consumers a better mousetrap, they're going to go get it. And Amazon's proved that. 15 years ago, we could only get books from Amazon. And now Amazon has replaced, especially in this pandemic, that I can get the light bulbs I need delivered to my door in 2 days, even while we're all shut down and we're all at varying levels of quarantine. So I see that as we ride out this pandemic and get to the other side, you'll see an explosion of entrepreneurialism driven by the opportunity and the pent-up demand of entrepreneurs to make things happen.
That's helpful, and thank you for striking such an optimistic tone. Don, I'd like to hand it back to you now to talk a little bit about what you think the next round of stimulus might look like. You've been very consistent in telling everybody that in order for stimulus to be effective, it needs to be targeted, timely, and temporary so that it doesn't have these long-run effects that can be so pernicious, including inflation and currency debasement and so forth. And of course, the CARES Act, I think, surprised everybody with how quickly it was done, you know, the shock and awe with which it was delivered, and its focus on some of these small businesses through the payroll protection program that Joe outlined. I know the next round has become subject to horse trading, and I know your colleague, Dan Clifton, is pretty close to Washington, D.C. What do you think we should be expecting in the next few weeks ahead of the election as fiscal policy continues to try to step up to the plate?
Yeah, and it's probably become the critical question for the next couple of weeks as we've hit the point where some of the unemployment benefits that were added on to the typical programs have now expired. So I'd say the CARES Act was an emergency bill. It had some support for that reason that got it into a bipartisan position. This bill that's moving right now is a more typically political bill. And that's why to get it done, it's going to have to be a number of economic things that both sides might not typically agree with, and perhaps some non-economic things like limiting liability for employers. In other words, if there's a certain set of conditions that are laid out, a certain set of protections, then if the employer follows these guidelines, maybe we could limit the liability for the virus going forward. So that's being discussed as well. But on the economic side in particular, there are a couple things. So there's going to be a push for more income for consumers. The consumer is terribly important. It's just about 70% of US GDP. So if we're going to have a bill that helps, it's likely going to have to continue some of these transfers simply because we're not allowing the economy to function normally right now. So there are some individuals and some people at companies that can't go to work the way they normally would because of some of the health concerns. So as long as there's not a health solution to the health problem, which I hope happens soon, I hope there's a vaccine, I hope there's a therapeutic, but assuming that that's not the case yet, we are restricting behavior, and that's where some of the income replacement in this particular case can make sense. So it's going to have some of those elements, we believe. Another area that has been thus far untreated, I'd say, is the state and local issue. And so we really need this next bill to start to address that. We have about 20 million workers tied to state and local governments in one way or another. So it's a large number, and to let that fail after all we've done. In other words, it's not something that's simple, but we have done a lot. We've added trillions of dollars to the economy, an extra several $100 billion to address state and local issues in this context probably makes sense. So we would view the state and local patch as something that probably has to pass. It'll be in there, but it'll be in there with some trading of different items to get a bill that could wind up around $1.5 trillion when it's all said and done here. And that's an enormous number. It only sounds less enormous because we did other trillion-dollar bills already this year, but we have added quite a bit of funding, and it's been very important.
Yeah, thank you. So, Frank, I'd like to turn our attention to a theme that has emanated through everybody's comments, and that is government staying out of the way, letting businesses do what they do best, which is take risk, invest for the future, and hire. There's a lot of talk about how big cap technology companies have emerged as clear winners. I think you talked about the habits that have changed by buying everything online with Amazon. What do you think needs to be done, if at all, with a handful of companies emerging from the pandemic as clear winners? And what are your thoughts on whether they are a monopolistic threat to competition?
So I'll this one is, I have a point of view. I can't say as I've studied the antitrust issues very intensely for Google, Apple, or Amazon. But my answer is the focus should be on the consumer and what are the best answers for the consumer. And I'd be hard pressed to see that breaking up those companies is a great answer for consumers. If there's an argument there, I haven't seen it. I know, having competed against Amazon directly, my view was always Amazon has a great solution for customers. Our job is to provide a better one. And I think that's the way most competitors should look at it. And again, not look to government to help them with Amazon, or for that matter, Google or Facebook or any of the others. But I think it does go back to the itch to politically get your druthers in, and once the government starts down that path, I think rarely has positive results. The law of unintended consequences is huge.
That's very well said. Don, can you respond to that? I think, we receive a lot of questions here at our firm about what the policy landscape might look like over the next 4 years. Perhaps you can respond to Frank's comments around regulating big cap tech, as well as what you think fiscal policy may turn its focus to if, say, candidate Biden were to win and it was a Republican Senate, or what it might look like if candidate Biden were to win and it was a Democratic sweep and the Senate fell into the Democratic Party's hands.
Yeah, and this is really an issue that's become more important after the pandemic. I'd say when we would talk to our clients back in February, I think there was a consensus developing that the status quo had some chance of lasting, whether that meant the current administration would get another 4 years, or it meant you'd have a change in administration in the White House, but not the Senate. And then that would be enough where you'd wind up with gridlock. So that was the view as of February. I'd say the chance that you get a Democratic sweep in November is now rising, it looks like. And so we've had such a dislocation that we are creating political volatility. Even with the unemployment rate coming down a bit, it's still double digit. It was reported at 11%, and we could talk about exactly what goes into that number. But it's pretty clear we have high unemployment that's lingering, and high unemployment that sticks around is politically unstable. People are going to look for some solution. And so that solution could come from fiscal policy on the spending side. It could also come on the tax side. There doesn't seem to be a market reason that we're in need of tax increases right now, yet that's part of the platform that Joe Biden has laid out as an example. So campaigning is always different than governing. We know that, and we should think about that going into next year. But the idea that the corporate tax rate could change several years ago with the tax cut, could it go the other way? Could we have different taxes on asset classes? We have to think about that too. And some of this could be done as part of a broad package. There could be spending on the other side, perhaps on some sort of investment or infrastructure plan. But that's really something that'll happen in 2021, 2022, given the natural lags of that type of activity. So infrastructure is not terribly good stimulus in the short run, has been the experience that we've seen. So a lot of possible change. If we wanted a number to watch, let's watch the odds the Senate flips. That probably gives us some indication of the probability that we're looking at a sweep, that we're looking at a dramatic change in the tax code, and then maybe the orientation on the spending side as well. But it's a long way to go before the election, but it's going to occupy a lot of airtime in the next few months.
There certainly is, and the last 4 years have taught us just how accurate pollsters are, right? Joe, I'm going to ask a follow-on question on this theme from a small business perspective, but Don, to Frank's comments about regulation and the law of unintended consequences, perhaps one of the benefits of the Dodd-Frank regulation was adequate capital that banks had in the lead up to this crisis. Can you talk a little bit about the long-run trends in the financial sector 4 years hence, about their capacity and willingness to continue to lend?
Well, I'd like to believe that it would continue to be in place. We talk about the consumer and how the consumer is the engine behind the American economy. And we know that 60 to 70% of employees sit inside of small and mid-sized businesses. So the degree to which we can engage and generate positive financial situations for these business owners, these CEOs, professional CEOs, to invest in their business, to grow their capabilities, and again, to fill some of the gaps that will be created by some of the devastation of COVID, is only going to allow them to continue to grow and prosper and hire people. And when small and mid-sized businesses expand, that they invest in equipment, they invest in facilities, they invest in people. And those people come into jobs, and those jobs turn into income that turn into people going to grocery stores and other places and spending that money. So it becomes almost a vicious circle that if you want the consumer to drive the economy, you have to ensure that this unemployment rate comes down. Now, it doesn't have to be at the full employment we were at 6 months ago, but certainly to get jobs into people's hands. We also haven't seen the big layoffs from the big companies yet, and those are just starting. So as you look ahead and you try to look down the path for fiscal incentives, it's clear that maintaining the energy into the small and mid-sized business space is going to fuel those businesses to invest in their facilities, their capabilities, and most importantly, the people, because it's the people that are going to drive that local community's economic stimulus and bring those local communities back as we all struggle to come back from this thing.
Are you hearing anything within the Vistage network about small to medium-sized businesses struggling to get credit lines and access to credit being turned?
We haven't seen trouble with people getting access to credit. In fact, those organizations, those businesses who had pre-existing lines of credit in place, as we've recommended to them for years and years and years, those that had established relationships with their banks, specifically the local community banks, which were much more effective at getting PPP applications through. Those businesses that manage their financial portfolio with discipline and lack of emotion have those relationships in place and therefore are positioned to go. Those that are not, well, they struggle like everybody else. But we believe that the ability to invest in small and mid-sized businesses doesn't just help the economy, but it helps the American consumer. And that in turn helps the American economy. So we hope that we'll continue to see that because our businesses want to grow.
Yeah, I mean, that's a theme that I've been talking to Vistage companies about for years. And, pre-COVID, there certainly seemed to be this trend for mergers and acquisitions and consolidation within the banking sector. But, these smaller banks really performed very well if you're a
brilliantly,
very, very well. And it's be interesting to see whether that trend that had been in place pre-pandemic might actually be arrested. Why don't you tell viewers where they can find your CEO Confidence Index and some of the decision points that you put out for the Vistage network?
Certainly, Adrian. It's vistage.com, vistage.com. That'll take you to our corporate website. You look up and you click under research, and you'll see the research that we publish. You'll see our CEO Confidence Index, our Small Business Confidence Index, and the other assets that we create. We're focused on helping all small and mid-sized business CEOs become better leaders, make better decisions, get better results, and we share our information freely. So I invite people to come to vistage.com, go to the research tab, and explore all that we have.
Thank you very much. I appreciate that. Gentlemen, I appreciate your time very much. There's some important themes that we have all talked about today, but I'd like to end off our time together on the subject of habits that I think Frank and Joe and Don have all talked about. I would like to ask each of you a good habit that you developed during COVID that you will do more of, and a bad habit that you were unaware of pre-COVID that you are going to stop doing. So Don, I'll start with you.
Okay, so I've had to change a tire on my car myself. Learning how to do that was something I probably should have investigated before pulling over. So being prepared, I'd say, is a good habit that I've learned. Now, in terms of other things, yeah, just rediscovering the outdoors of New Jersey.
Yeah.
Given that the gyms are closed and there aren't the same opportunities that there would be for indoor activity, I've found that to be quite refreshing.
Thank you, Frank. Why don't you have a turn to respond, but also tell listeners about your podcast series that I enjoy listening to.
Well, thank you for that, Adrian. First on the good habits, like Don, the main good habit has been a lot of walking.
Yes.
So my wife Liz and I we walk like an hour and a half a day, and that's great. Just getting outside and walking. On the habit that I'd like to, that has been revealed to me through the pandemic that I got to figure out a way to work around is I did an awful lot of meetings. I don't mean to put pressure on restaurants, but I would do an awful lot of meetings over lunch and breakfast. And one of the things that's been revealed on this is I'm not a huge fan of these, of virtual meetings, but I have become a much bigger fan of not always meeting over food. So that's a good habit to change. The podcast, and thank you for the opportunity to say a word about it. It's a podcast that just celebrates people who do crazy good things for other people. And it came from my experience running Home Depot, and that one of the ways you change culture and move an organization is by celebrating and recognizing the people who are doing what you want them to do. And it's a tool that surprisingly few CEOs are really serious about. I like to say, we all know that in business, you get what you measure. I would say there's a corollary to that you get what you celebrate. And the recognition and celebration is hugely important. And so that's what we try to do in the podcast. And it's been a blast because we have just amazingly great stories of people who do wonderful things, even in the worst of times.
Well, keep up the good work. I'm an enthusiastic listener, and I've tried to take a leaf out of your book by doing that at Ballantine every day. So thank you very much for your time today. I know how busy you are. What about you, Joe?
I think the good habit for me has been the value of consistent and extended sleep. Going to bed at the same time, getting up at the same time. I was a road warrior, Frank. I spent a lot of time on your airplanes. Every week I was somewhere, and that obviously disrupts the sleep pattern. I have not been on an airplane since March 13th, and consequently my sleep pattern has been improved. The bad habit is that I am now focused intently on this small screen that I'm focused on and tend to just sit here and get into the flow. And 4 hours later, my wife will slip some food under the door and I'll get up on my neck and my back will be sore. So the bad habit is I'm not taking the discipline of taking the regular breaks that I have. But the good habit is I'm sleeping much better, and that's a good thing.
Well, there you go. We're all sleeping better, eating less, walking more, and we're changing tires. We all know how to change our own tires.
What's your answer to that?
Yeah. Reading. Reading is the good habit, I think. I have watched far less television than I normally do. And so the good habit has been me being able to find time to doing more reading. And I would say the bad habit that I was maybe unaware of was how your day and calendar gets filled up with, I would describe as ineffectual meetings, in-person meetings. And so I have found that people have been much more intentional about communication and thoughtful. And so, fewer meetings make me more effective. So that's how I've changed my behavior. Gentlemen, thank you very much for your time today. Don, I'm very appreciative of Strategas and their support for our firm and for our clients. And Frank, you have a busy schedule. I know how far in advance we have to get hold of you. And Joe, keep up the good work. I really do appreciate your time. Please let us know if there's anything we can do to help you as a result of today.
Terrific. Thank you, Adrian.
Thank you.
Don and Joe.
Bye.
Bye.
So in summarizing today's panel discussion, some of the key themes about what the post-pandemic economy might look like that emerged for me included the effectiveness of continued fiscal and monetary policy in setting the stage for the shape and robustness of the future recovery. As Don described, that will be heavily influenced by the upcoming election. Secondly, from a business owner perspective, the ability for management teams to flex the muscle of agility and nimbleness and to make decisions more quickly and to be willing to adapt to new habits and discard old habits, just as every crisis brings to the surface, as Frank discussed. And thirdly, how expectations and confidence, especially among small and medium-sized businesses, as Joe described, can translate into future business investment, risk-taking, and job creation. And then finally, that each of the panelists today had learned a new habit during COVID-19 and discarded some old habits, just as I'm sure many of you have. Thank you very much to our panelists for investing time with us today to share their key insights. Don, Frank, and Joe all shared complementary views from their unique vantage points. Before wrapping up, I would like to remind you all to please visit our website for more resources and other Road to Recovery webinars. This was the third installment in our series. As I said earlier, we also hosted a private capital discussion with 3 venture capital firms and a supply chain panel that included Griff Lynch of the Georgia Ports Authority. We have received tremendous feedback from both those episodes. Forthcoming in our series, we will be exploring discussions around higher education and the hospitality industry, 2 areas of our economy that have clearly been severely impacted by the pandemic. So please make sure you're registered on our website for updates as these new webinars become available. And if we can help you in any way as you think through how to navigate the road ahead, please contact us. I'm also pleased to share that I'm co-authoring a book that is scheduled for release at the end of this year. Along with my long-standing business partner, Ballantyne's chairman, Robert Ballantine, our book, which is called First Generation Wealth, aims to help entrepreneurs anticipate and prepare for the many forks in the road along their entrepreneurial and life journeys. I invite you to sign up for book updates at firstgenerationwealth.com. I hope this webinar was helpful to you as you think about positioning your business in a post-pandemic world. Thank you very much for your time and attention, and please let us know if you have any question. Enjoy the rest of your day.